Okay, good morning. We're going to go ahead and get started here only because our main speaker has limited time today. Good morning. Happy Father's Day weekend to everybody. And we appreciate you being here today. We know traffic is bad. There's an event in Washington. There's a crash in Annapolis, I've heard. So we'll go ahead and get started just in the interest of time. It seems like just yesterday we were meeting in this room, so I don't know where the last 3 months went. And so we're going to go ahead and just move on here. Today, if you have any Father's Day stories, I think we'd be happy to hear them later on, so just be thinking about that. It's Father's Day weekend. I want to just say a few words about Ben Proctor from Morgan Stanley. He's going to be more formally introduced by Jeff. When I was a young lawyer, I met Ben Proctor, and I'll just tell you, I felt the power this morning. Just when he came in, I saw the Range Rover drive in, and I saw Ben come in. He's a dynamic person. I'm not kidding when I say, I seriously said to Ben this morning, did you play a full court basketball game this morning before you even came here? And I wasn't kidding when I asked him that. Ben is a beach volleyball player. He's an athlete. He's a successful person in many, many different respects. In all seriousness, Ben was a beach volleyball player in years past and still is. Now, I heard that here at the college there's a beach volleyball pit, Ben. I heard about it. And I did hear through the grapevine that Ben and Jeff were going to have a match directly after this meeting this morning. And I also heard that Gary was going to be on Jeff's team. So it's going to be 2-on-1 or 1-on-2. Okay. By the way, if you want to participate later, we'll have a sign-up sheet. With all that said, welcome, and I'm going to turn it over to Jeff.
Thanks, Steve. And welcome to our second quarter client care program event. Many of you have been here before. Just a few brief housekeeping items. Restrooms are out the door and to your left, and certainly we have plenty of food, water, refreshments, coffee, tea, help yourself at any time. And so we have Steve and Gary here as always. Welcome to both of you. And also our special guest presenter, Mr. Ben Proctor of Morgan Stanley. And I'm so pleased to have Ben here today. So I'd like to give him a formal introduction. So Ben is an executive director and certified financial planner with Morgan Stanley. Ben has been recognized several times by Forbes as one of their best in-state advisors in Maryland. Ben has been with Morgan Stanley and predecessor Smith Barney for 25 years. And every time I talk to Ben or think of Ben, I think of my dad, because my dad was also with Morgan Stanley and Smith Barney and Dean Witter and Legg Mason all those years ago. So I think Ben is actually in the exact same office that my dad ended his career in. So good memories. Morgan Stanley Wealth Management presently has $2.3 trillion under management for successful investors across the U.S. and world. And Ben's strengths include providing holistic, unbiased, and comprehensive wealth management advice and service to affluent retirees with net worths generally between $2 million and $25 million. And a few things we really appreciate about that. Ben is married to his wife, Sherry, and they will celebrate their 23rd wedding anniversary this month. Congratulations. They have 2 teenagers, one at the University of Alabama, and a son going into his senior year of high school. He enjoys his time away from the office as president of his kids' high school sports boosters, raising money for their student athletes, as well as playing tennis and doubles volleyball, as well as landscaping and decorating. And Ben is a graduate from the University of Maryland College Park, for any of our Terps fans out there. And I've been fortunate to know Ben since I started Elville back in 2013. Steve's known him much longer than that. He's known for his consistent high-level client service and knowledge. And my extended family experienced that personally over the years in some pretty dramatic times of loss. Ben was there for my mom and others to see us through that, so I'm very grateful to Ben personally. And he's advised and counseled countless clients with the firm over the years, just as we do. Ben believes in the planning team concept, working to best serve clients. And lastly, Ben is a sponsor of the Elville Center for the Creative Arts through his office in Morgan Stanley, so we're grateful for that as well. So Ben Proctor, everybody.
Thank you so much. Good morning, everybody.
Morning.
Good morning. All right. I'm so delighted to be here this morning with you. And I do say that out of respect for Jeff and for Gary and for Steve. I've been doing this for 25 years now, and without equal, I have found that for my clients and myself, that these guys do such an exceptional job when it comes to estate planning. So I'm really grateful for that relationship. I think most importantly though, and I've made this comment a lot of times, as exceptional of attorneys as these guys are, I think they're even better human beings. What I've noticed over the years is how selfless they are. They put their clients' needs, their family's needs, their friends' needs ahead of their own. And we also share the same values as it pertains to education and creating the best client experience that we can. So that's why I'm so honored and grateful to be here this morning. As Jeff mentioned, I'm an executive director, so I'm a senior level advisor with Morgan Stanley. It seems like a lot of folks have their positions in Green Spring Station up in Lutherville, the Johns Hopkins Pavilions. So that's where our office is. My clients are mostly in Maryland, but throughout the country, usually over the age of 50. They've accumulated wealth, and again, generally have between $2 and $20 million under my stewardship at Green Spring Station. The office is north of $20 billion under management at this time. As Jeff mentioned, what I do well, what I'm passionate about, is providing holistic wealth management advice to our clients. So my challenge today is to share with you, and I've had a few weeks to prep for this, how do I share information that is going to appeal to the majority of you? There's so much information that we could review as it pertains to the markets or planning. And so I wanted to get some audience participation here and ask for your feedback. So if I could just get a show of hands of who would be interested in seeing, in fact, an update on the markets today while we talk. All right, I see some hands going up. And then, is anybody concerned about the state of the markets and the impact that may have on your portfolio? Okay, especially after the news yesterday, right, out of the Middle East, right? I think we all saw that. Who would have an interest in learning a little bit more this morning about what we feel constitutes a complete financial plan? Okay, see a show of hands going up. Terrific. Is anybody here familiar with probability analysis or Monte Carlo simulations? All right, I see some hands going up. And does anybody here have a financial plan that incorporates Monte Carlo simulations or probability analysis? All right, I see a couple hands going up. All right. And then, is there interest in learning about any investment ideas? I get asked that from time to time. Okay, I see some hands going up there. All right, terrific. All right, well, wonderful. Well, why don't we go ahead and jump into it. I do have prepared remarks, and I think we're going to be able to touch on all this today. Jeff, do I have is there a pointer by any chance?
The clicker may be a pointer.
If it's not, that's fine. Oh, perfect. All right, terrific. Anybody ever use a pointer? These are so much fun. So powerful.
Especially if you have a cat.
Yep.
I'm sorry?
If you have a cat.
If you have a cat, yes, that's right. Okay, so here's what's happened over the last 12 months, folks. All right, this is at the very top are the U.S. markets. All right, so the S&P 500. The S&P 500, for those of you who do not know, that's the 500 largest traded, publicly traded companies in the U.S. economy. All right, includes companies such as Apple and Microsoft and other companies that you've not heard of, the smaller companies. But you see the NASDAQ here at the very top, and so those are your sexy technology stocks, what we call the Magnificent Seven stocks. And you can see here for the last 12 months, if you look particularly right here at the beginning of the year, do you guys see this gap right here? It's a pretty big gap here between the U.S. and the rest of the world. And then if you look here more recently, we see that that gap has closed. And what that is reflecting is that the rest of the world has caught up with U.S. markets. As a matter of fact, the U.S. markets are pretty flat on the year, but if you look at European and Asian and emerging stocks, they're up 15 to 25% on the year, right? And coming into this year, nobody liked the idea of investing in overseas stocks because they didn't look too good over the last 10 years. So what you do see here is excess return for U.S. markets over the rest of the world. That's what that is reflecting. Now, this color quilt here is simply reflecting what's happened over the last 10 years. And what I'll note here is these dark blue boxes, U.S. large cap, U.S. large cap, U.S. large cap, 23 and 24, and for the last 10 years, again, the story has been large caps. Remember I mentioned that for the year, emerging markets and European stocks have done quite well, but you see them here in the bottom half, including emerging markets, as we look at the last 10 years. Now, part of this has been because of the weak dollar this year. The weak U.S. dollar has helped overseas securities do quite well this year. So again, U.S. stocks over the last 10 years have averaged almost 13% per year. But what's interesting is that if you look at the previous decades, you can see that U.S. stocks here are not always the leader, right? So we call this the lost decade between 2000 and 2009, where U.S. stocks, if it were not for the dividend, actually had a negative return. Anybody ever heard of the lost decade, referred to as the lost decade? Okay. So in review, this is only through May 31st, but you do see the NASDAQ, these are your technology stocks, this is the S&P 500, both negative through May 31st, and they are still positive actually on the year now due to what's been a very good May up until Friday. What we also know is that your mid-cap stocks, this speaks to the importance of diversification. If you look year to date, you can see that it's been a good run for the trailing 12 months and also for year to date for your Russell 2000 growth stocks. Now, what's been happening is if we look at market cap weighted versus equal weighted, all right, so what does that mean? Market cap weighted means that your larger companies in the U.S. economy count more, for better or worse, for how the U.S. stock market does. Right? But if we look at equal weighted, what that means is that every company in the S&P 500 carries an equal weighting. It means that companies you haven't heard of, all right, have just as much of an impact on the index as your large companies do. And so the relevance that I'm sharing here with you is that when we look at the price that we have to pay as investors relative to the earnings that these companies are bringing in, what we know is that we've got to pay more for these larger companies right now than may be justified relative to the earnings that they're bringing in. So there is a little bit of caveat emptor right now when it comes to investing, and that is being aware of where the valuations are right now. To put this in perspective, if you look at this right here, U.S. stocks, and you see 90%, what this means is that U.S. stocks have only been more expensive just 10% over the last 100 years. All right, so that's where we are right now with U.S. stocks. They're very expensive for what we have to pay to own them right now. So again, to speak to this, if we look at how the S&P looks relative to the rest of the world, you can see this is the U.S. right here. So we've got to pay this much in order to buy the rest of the world. We've got to pay this much in order to buy the U.S. Now, the challenge here is that when the price-to-earnings ratio gets up around 22, we're typically borrowing from the future, right? It means that we may be in for a more modest market on a go-forward basis. This is something I think is relevant. We're going to go through time periods where the U.S. or international stocks are better. And so you can see here that for 94 to 2001, the U.S. was much better than the rest of the world. International outperformed. And we have now had 16 years and a 365% difference there between the U.S. and the rest of the world. But nothing lasts forever, right? Going back to science class in high school, right? The string with the pendulum. The pendulum always does what? It always comes back to the middle, so we get reversion to the mean. So again, when we couple this with the fact that U.S. stocks are so expensive to the rest of the world, this is something for us to be paying attention to. So we talk about standard deviations. So 1 or 2 standard deviations, it just means that something has gotten out of whack, and we've got to get that reversion to the mean. So 1 of 2 things has to happen here when we look at the price of U.S. stocks. these price to earnings ratios have to come down, which means that either the price needs to come down or earnings needs to go up for U.S. stocks in order to get to a more reasonable price to earnings ratio. So as investors, right, we think about risk assets. These include stocks, bonds, real estate, commodities, what we call real assets. And so our opportunity cost right now, what we're showing you here is that the earnings yield is pretty low, all right, relative to where the 3-month Treasury bill yield is right now. In other words, it's possible that investors could do as well in fixed income as they could in equities based on where valuations are right now. To wit, again, whenever you see standard deviations and talk about that, it just means that something is out of whack. It should get our attention. And this is simply reflecting here that the bond valuations are very attractive relative to stocks right now. As far as our forecast, all right, you see year-end forecast, and really this is looking out between December and halfway through next year. You do see 6,500 on the S&P 500, and that would imply approximately a 12% increase, all right, 10 to 12% increase from where the market is right now as we look out over the next 12 months. That doesn't sound so bad, but again, opportunities may be elsewhere as we look at the rest of the world. So I think it's really important because a lot of hands went up here, right? And we talked about concerns about the markets and the impact that may have on our portfolios. And so it's really important to look at, well, if I want to diversify my assets, how did fixed income or bonds perform when we've had difficult stock years? And what you'll notice here is that with the exception of right here, 1939, with the exception of 1953, and with the exception here of 2022, generally bonds have been higher when stocks have had negative years. In other words, traditionally bonds have had a low to negative correlation relative to equities when equities have had down years. Now, this is what's in everybody's recent memory, right? Bonds were down 13% in 22. And that was, does anybody know why bonds were down in 22? Or one reason? What did we have following COVID? Or what did we do during COVID in order to stimulate the economy? A lot of money. We created money, right? We created that money. What did that end up causing? Inflation. Has everybody here seen an uptick in what you're spending on a monthly basis? What about it? I'm just curious. Insurance, life, not life, but homeowners, auto, umbrella, right? 27%. I actually get 27% increase for our policy year over year, and that was without any claims. So, you know, we are, by the way, here in Maryland, we are paying the price a little bit for what's happening out in California and Florida, right? It does find its way into the rest of the marketplace. So in any event, we do, so this was literally a positive correlation. Stocks were down, bonds were down, they didn't do what they're supposed to do. Inflation's been coming down though, and so this does present probably a very good opportunity for fixed income investors right now. So just showing the amount, all right, so again, I see the room here, we have folks who are retired or close to it. What we know is that right now to generate $20,000 a year in fixed income, while you only need $250,000 in high-yield bonds or junk bonds, we know that you need over $500,000 just based on where the 2-year Treasury rate is right now. All right. So consumer confidence is pretty low right now. This has not changed since April 30th, and certainly it's going to be lower after what happened yesterday. However, all right, with the exception of where we've had recessions, traditionally when we've had low consumer confidence, where we have not had greed, if you will, in the markets, that has boded well for the stock market. So again, to be clear, if we go back to 1990, what you see is you see an increase in earnings, all right, over the years. And that is because over time, the stock market, while nothing's assured for the future, the stock market has gone higher over time. And that's been because of earnings. So right now we are in a bull market. It's 13 years running. Again, our outlook is 6,500 on the S&P. Our bull case scenario, if things go really great. And the bear case scenario, which is 4,600. So we always provide 3 different case scenarios. Things going really well. Our base case, which is based on earnings and valuations. And again, when things don't go too well. show of hands of here, who's heard of alternative investments or that term before? Okay, see a few hands. So we have stocks, we have bonds, and we have alternative investments. All right, alternatives refer to assets that we can't classify as stocks and bonds. All right, this includes real assets such as commodities and real estate. Why? Because they have the ability to zig when stocks and bonds are zagging, for example. This also includes hedged strategies like hedge funds or mutual funds that might have market neutral type properties. I have exposure to hedge funds with my capital, with part of my capital, because it gives me an opportunity to dampen portfolio volatility over the long run. What you're seeing here is that a traditional curve here, this is showing 100% in bonds here, a balance between stocks and bonds, and everything in stocks. This curve moving this way to the left, you're going to see it incorporates alternatives. So what's happening here? Why is this curve here better than this what we call efficient frontier here? So we have risk and volatility down here. We have returns over here. So if this is risk, we're going from no risk to maximum risk over here, and no returns to high returns over here. Why would this efficient frontier be better than this one right here for investors?
Less risk with the same return?
Less risk and the same return, if not even a little bit of an uptick there. So that is the rationale for alternative investments. All right, I own alternative investments with my own capital. So to be clear, if we look at past bear markets, U.S. stocks were down 46% from March of 2000 to October of 2002. Hedge funds were down 1%. But if you look at the next period when things are going well, stocks are up almost 120%. Hedge funds are going to lag because hedge funds are driving with their foot on the brake. All right, they're going to have what we call short exposure, which means that they're not going to have the ability to participate fully to the upside in order to protect better to the downside. And so you see that here, U.S. stocks down 55, hedge funds down 19. But for this most recent run, stocks up 800%, hedge funds up 122. So again, like anything in our garage or tool shed, there's right tools for the right job. Some tools may not be appropriate for what we're trying to do, depending on everybody's objectives. So we mentioned companies like Apple and Microsoft, certainly Nvidia, Tesla. Those are what we call growth stocks. And what we know is that growth stocks have done much better than financial stocks or value stocks, which includes financial stocks. But again, the question is this getting long in tooth, or is this the new regime? All right, is it growth stocks forever, or is it important to have some exposure to value stocks? So again, that's the million-dollar question here. Again, you see the just complete shellacking of value stocks relative to growth stocks. But again, is that getting long in the tooth? This just reflects the outperformance, again, of growth stocks relative to value stocks. We just talked about inflation. So 1985, I think a lot of us were teenagers, all right, back in the 80s, 70s and 80s. So a dollar has lost 65% of its value since 1985. All right. We have Terps. We have any Maryland Terp graduates here? Maryland graduates? See a few hands. So Gary and I were talking about this earlier. 1986, June 19th, 1986. Yeah, that was when Len Bias passed away. But so since that time frame, right? 85, 86, 85 was what Reagan's first year during his second term. Dollar's lost 65% of its value. So couple this with people living longer, right? It really puts our eye on how important it is to maintain our purchasing power, right, over the long run. I'm going to come back to that. So inflation expectations are somewhat benign. You can see here where we were here, where we are, even though we talked about, again, inflation and what we see in the real world. Yes, sir?
Yeah, just that devaluation of the dollar, right? That's just going to continue? I mean, there's nothing to bring it back up?
So I think everybody heard the question. So are we looking at a continuation of the weak dollar? In my opinion, I think that it's likely that we'll see a continued deterioration of the U.S. dollar, right? which is not necessarily a negative, right? It might have been a surprise to some that Trump approved, right, Nippon Steel buying U.S. steel. But at the end of the day, a weaker dollar, right, makes it cheaper for us to manufacture and export to the rest of the world. And that's really at the crux of everything we're hearing regarding tariffs, right? Tariffs are inflationary. While I'm not a big fan of tariffs, at the end of the day, if we can produce more here, right, they want to be able to export that to the rest of the world. So again, a weaker dollar, and not only that, but the current administration would like to see lower interest rates, right? So if we see that, then you'll see a weaker dollar. I've been asked, well, what's in it for the rest of the world to continue to hold U.S. dollars, right? What would stop China just from selling all of the U.S. debt? Well, at the end of the day, we're in bed together, right? Every day they wake up over there, this is the politicians, and they have to worry about how they're going to put all of their citizens to work that day, right? So whether we like it or not, right, we're in bed together, as an example with China. Rare earths, right? This is a part of the conversation right now. It's interesting because back in the 80s, we made a deliberate decision to go ahead and move away from rare earths. And even if we're to get back into it today, right, you look at, let's say, Montana, it would cost $120,000 a year to have a mining engineer employed for what you can do on the cheap in China, right? So it is cheaper at the end of the day to export that, and rather, we'll export the labor and import the actual products. I heard this morning that they had to stop or halt production of Ford Explorers, based on not being able to get some rare earths, for example. But in the next few years, we think that we'll be more independent of China, of our need with developing technologies for those rare earths. So net, our forecast is that the 10-year Treasury that yields, we think we're going to see yields continue to come down. And I don't have this slide prepared this morning, but I actually could show you that fixed income has done better than cash whenever we've reached peak interest rates. Okay? We've reached peak interest rates. It feels good right now to talk about money market funds. Money market fund that I use is paying, 4.3%. It's liquid daily. But all of these statistics have said that when we reach peak rates, that bonds have done better than cash or cash equivalents than we've looked at 1, 3, and 5 years later. So again, inflation, declining rates. We've got to be careful about getting too comfortable with cash right now, depending on what one's objectives might be. So again, rates are on the way down. We have not seen, our base case is that we do not see a recession. We do see very slow growth, which will partly be a reason that we can see interest rates coming down over the next couple of years. So corrections, we don't like corrections, right? Nobody likes corrections. They're not fun. We got a big one at the beginning of April. And then before you know it, the market was back up and flat for the year. But the average months to recover is almost a year for an average correction. But when we have 10 to 20% corrections, believe it or not, it only takes about 4 months, all right, for the market to recover. It's kind of interesting, right, to see it that way. So again, it doesn't feel good, but this is historically where we've been with that. This being said, right, when we retire and we don't have a paycheck anymore, and not only that, but we're getting older, we don't have as much time to make up for losses. And the bigger the loss, the bigger the gain has to be to get back to even, right? So if we're down 10%, we've got to be up 11. If we're down 30%, we've got to be up 43. If we lose half of our capital, we've got to be up 100% to get back to even. And by the way, the worst years to experience a loss are the first 2 years of one's retirement. First 2 years. Because we're pulling capital from a declining asset value. I'm going to touch on a strategy to mitigate that. Not eliminate it, but mitigate it here in the financial planning segment that I'll be talking about in 3 hours. Okay.
Yeah, we heard it.
I got a lacrosse game to go to. Anybody's kids or grandkids play club lacrosse or club baseball? See some hands going up. My son's 17. He's going into his senior year. This is the last club lacrosse summer. And today and tomorrow are the last days we'll play club lacrosse. So we've got a game at 1 o'clock in Towson. So even if you guys are the best audience in sliced bread, I'm out of here. I'm going to be I either gotta change or close, but if I get there too late, I'm gonna show up in a game and miss it today. So I'll be running through the parking lot like, you know, so. The bond market, U.S. bond market versus the S&P, just another look at this. The good takeaways here, all right, are that we haven't seen that many down years since 1978 in the stock market here. It's really interesting to see this. Of course, we have the three there between 2000, 2001, and 2002. But your yellow diamonds here, or gold diamonds, these are what bonds did. And again, you don't see many diamonds here that are negative, many bond years that were declining. U.S. stocks really finished the year at their maximum inter-year drawdown, so we've really got to be careful about, well, number one, we've got to ensure that the asset allocation we have is right for us, right? Everybody in this room is different as far as investing. You've got to make sure that the asset allocation is right for you, but also more specifically that the allocation is correct based on when you need that money, all right? What I like to use for clients is what I call a bucket approach, all right? Meaning that when the money is needed, that's how the money should be invested. All right, so I will have clients that have IRAs, and we will invest that IRA. We might split that rollover up into 4 accounts. The account that they're going to draw from for the next year to 2, cash or short-term bonds or both. We're not worried about the markets in that kind of scenario. Another 2 accounts might be more of a moderate mix, right, where we have a couple more years and we can withstand some of that. Maybe fluctuations, but the fluctuations won't be much. The longer term account being more aggressive, but overall ensuring that that overall allocation is consistent with the amount of risk, right, that the investor is willing to take, but more importantly, that it's not more risk than we need to take in order to accomplish our goals. Right? If we're going to be able to accomplish our goals, that would make the case for not needing to be as aggressive with the allocation. So my daughter's at Alabama, she's going in her sophomore year. A little bit of drama this year, but all in all, a good year. She found out this week that she made Dean's List. That's because of her mom. She's got a smart mom. And so the money that we are pulling, right, from the college accounts is relatively conservatively allocated right now. So that mom and dad don't need to stress out for not if, but when we have market dislocations like we just experienced in April. Right? All right. Market timing. Has anybody here ever been able to time the markets? I've seen it about a dozen times in my 25-year career. And I'm going to pick on the guys. It's always the guys. It's not the girls, all right? And I've never seen anybody get it right. And it's ended up with, I remember, early 2020, really smart client, president of an engineering firm, thought he could time it. I had to bargain, so we bargained to keep part of the money invested. A phone call several months later started out with, what's the damage that I did? What do we do to remedy this? The vault is lost forever, okay? Because there's no announcement from the market that, hey, we're going to go ahead and start moving up here. So market timing is a fool's errand, as they say. And you can see here that just missing 15 or 30, you can see the different dates here, can really impact how we do over the long run. So again, we're going to have some of these bigger drawdowns. And when you want to try to miss the worst days, in many cases, those best days happen right around the worst days. How many times have you seen it? A big down day, you're ready to hit that sell trigger, and the next day you wake up and for some reason the markets are up that day, right? And it could have been bad news that resulted in good news for the market moving higher, right? It could have been the economy is slowing down and more economists are projecting slower growth, and well, the market's up because now maybe we're expecting lower interest rates. So the market works sometimes in manners that we can't anticipate. This is really a terrific set of data here because these green diamonds here reflect, all right, inflows, all right, into domestic stock funds, or exchange-traded funds and mutual funds. And in many cases, what we see is we will see money coming out of the market after the market has moved down. It just speaks to the point that it's very difficult to time the markets. It speaks to having a professional and disciplined and objective approach to managing our hard-earned capital. So investor psychology, I don't know where we are right now, but certainly we got some laughs with this. At the top of the market, we've got greed and conviction. People's risk tolerance changes. Maybe we're too conservatively invested. Things move down a little bit. We're indifferent. We dismiss it. It's like the 5 stages of grief. We're denying it. Oh shoot. And now we hate the market. And when we hate the market, it moves up. Whatever. It's not going to last. Ooh, yes. Maybe we should buy some more. All right. So we got to guard against that. Still, over the long run, we can't lose sight of this. This is an abbreviated version since 1926. I think most folks in this room, we're going to be right here moving forward, right? So these are just headline really bad events. We're in a 24/7 news cycle now, right? So sometimes our worst enemy is what we call the bad news bears, right? It's only going to sell if it's bad news. The first news story on tonight's local news is not going to be about the local Boy Scout troop, all right? Or it's not going to be this walk that they're doing, right? This morning, this fundraiser. It's going to be about the fire. It's going to be about the murder, the homicide. It's going to be about something bad because that's what sells. So we've got to be careful with that when it comes to investing, all right? As human beings, we are hardwired the way that our cavemen and cavewomen ancestors were to seek out danger. And so that ticker tape on the bottom of the screen, the reason it goes from right to left is that's how the human brain is wired. We're constantly looking out there, where's the danger coming from? Where's the saber-toothed tiger? Where's the other tribe looking to take me out and take over my clan? So that is, we're predisposed, what's what I'm looking for? Thank you. To that. So we've got to guard against that when it comes to investing. Our forecast. All right, you see 3 efficient frontiers here. The blue is the historical 20-year period, 100% in stocks, all the way down to everything in bonds. So again, these are the returns here. This is the risk over here. If you look at the 20-year forecast, that is the orange. Our 7-year forecast is the green here. The green is lower because stock valuations are very high right now. And there's many forecasts right now that are estimating that bonds could do as well as equities as we look at over the next few years, but with less risk. And that's effectively what this is showing. In other words, having everything invested in stocks, it might result in an absolute return of 7%. But if you look at this point here, which is a balanced approach, 60-40, over 6%, but with half of the risk. Does that make sense? So a much smoother ride along the way. Something for us to pay attention to. I mentioned this, all right? So this is relevant, what I'm sharing with you. Current forward price-earnings ratio of 20. And it sounds geeky, but it's relevant. The price we're paying relative to the earnings our companies are bringing in, 20. So if you just find the 20 here, all these blue dots in this line here reflect the dispersion of returns from 1990 to 25. So 35 years, the dispersion of returns here. 10-year forward returns, when the price-earnings ratio has been 20, just find the 20 here. You can see that they're all dancing right around here. Everybody see this? So again, the past is no assurance of the future, but what it may be indicating is that we may be in for a modest stock market. Well, this is relevant, right? Because what's also happening right now is people are living longer. Anybody here have any relatives that are over 100? I see one. How old? Your mom just turned 100. That's fantastic. I talked to a client earlier this week. She's 96. If you just talked to her for the first time on the phone today, you would swear that she's 46. She's active. She is unbelievable. And so again, she made a comment that she didn't expect to live this long. So the fastest growing demographic in the United States right now are centenarians, 100-year-olds. So does anybody here have any friends who have relatives that are over 100? So now I see some more hands going up, right? We're going to be seeing more of this, right? You're going to be seeing more centenarians. Is it the Today Show or Good Morning America that did the Smucker segment?
Today Show.
The Today Show. Are they still doing that?
Yes.
Okay. Does it still say with a name like? No. say with it puts their name, well, it puts their name up there and how old they are. But they used to like put like words with a name, like, and because a lot of these names we go through these cycles where people have different names, and so, like my grandmother's name was Inez, and so, yeah, you don't see that anymore. But, next 12 months, price to earnings ratio, remember I showed you 20? This is over 21 for the S&P. All right, in the interest of time, I'm going to have to skip over some of these, but rebalancing is certainly relevant right now as we have certain asset classes that have done better than others. It's really important to have a disciplined, structural, objective approach to the rebalancing. We get asked about the market's doing better depending on who's in office. I can tell you literally for the last 2 elections that I've had at least a couple clients want to get out of stocks based on who won the election. So whether it's blue or red, the good news is that the market has generally moved higher regardless of that. I'm not going to get into debt, but it's definitely a concern. The more money that has to go towards paying the interest, that's less money that can go towards infrastructure. You can see this, it's definitely a concern, all right, with the interest expense, but in the interest of time, we're not going to be able to jump into that today. Policy uncertainty, I think we see that it's been pretty chaotic this year, hasn't it? All right, it's just every day there's some drama. Again, overall, we're seeing inflation coming down, but with lower growth and with tariffs, if we were to see an uptick, then some folks have raised that concern that we would have no growth and inflation, which is what we refer to stagflation, which is not where we want to be. Oil prices actually went up 8% yesterday with what's happening in the Middle East. And again, as we talked about this, you see some overseas securities here doing quite well through May 20th. All right, so it is something for us to be paying attention to. We're overweight U.S. stocks still, underweight Europe, overweight emerging markets. This presentation, by the way, everybody has my card, and you have also my email address here. I'll be more than happy to email this to you. Just you can send me an email over the weekend. We'll get the presentation to you on Monday. These are the alternatives that we talked about: real estate, commodities, infrastructure. So everybody's hearing about AI, all these data centers going in. That means infrastructure. Okay? So that's absolutely, I think, a really good play right now. I know I have a healthy allocation in my portfolio. And then you can see for the long run, again, I think over the long run, though, the markets move higher over our lifetime. And you can see here that this is reflecting small company stocks, large company stocks. You're seeing here that this is long-term government bonds. This is inflation and T-bills. All right, 30-day T-bills. That would be basically the same thing as the savings account at the bank. All right. So again, we're living longer. It's a highly personal decision with how we're investing capital, but these are all the little nuances, the little subtleties that can make a difference in maximizing one's retirement. All right, so are we still good with time? Okay. Let's see here. Does anybody have any questions about what we just reviewed related to the markets? Yes, Gary.
Did I understand correctly when you said, although maybe immediately, because of what's going on in the Middle East, the stock market is affected, but over time that actually helps the stock market?
With what's happening in the Middle East right now?
Yeah, and when there's war in the world, is that usually negatively to the stock market or over time positively?
So with conflicts that we've had in the past, right, the market ultimately moves higher. And I think it really comes down to really 2 things. Number 1, improvements in technology, so everybody becomes more productive, right? Number 2, having more human beings on the planet, right? So there's more demands for bottles of water, room space at the college, ties, shoes, chairs, and so forth and so on. But with what happened in the Middle East yesterday, it was inflationary. We saw bond yields going higher. That was good for bonds yesterday, seeing the yields go higher. So bonds actually went up in value yesterday, all right, with stocks being down. So, but yeah, I mean, it could be good because you have slower growth and less interest charges, and so that's positive for corporations and consumers alike.
Ben, I know your time is limited. Could you talk about people that have concentrated positions and make sure people understand what tools are available if they have concentrated positions?
Sure. So Steve's question is about having concentrated positions. There are different strategies, and this will. I'm not going to delve too deeply into this right now, but yeah, I'll just give you one example. McCormick. Everybody here have McCormick spices, right? So one of our clients at McCormick Executive retired. A lot more in McCormick stock, as an example, than he would like to have right now. So we just moved $1.5 million into what's referred to as an exchange fund. All right. The reason that he didn't want to sell the shares outright is because the shares have been held for a long time, and so there's a very low cost basis, right? So we didn't want to pay the tax bill. So these exchange funds came out in 1961, all right, and are a vehicle to exchange the shares of, let's say, a concentrated stock into a fund, and in return you get exposure to the S&P 500 or a more broader index like the Russell 3000. The client still gets a step up in cost basis at death, and it's just been a really productive vehicle, for
No capital gain, right?
there's no capital gains from doing that. So it's we were certainly proud to bring the solution to the to the client's attention for sure. Thank you, Steve. So as far as retirement planning is concerned, this is really the more important stuff, right? I know it's nice to talk about the markets, but we touched on some of these important factors today: increased life expectancies, rising healthcare costs, rising insurance. Anybody here concerned about Social Security? Yeah, okay. And pension plans, right? So I've got a Zoom meeting on Friday morning at 11 with a client who is concerned about being downsized from the government right now, right? So that's gonna, there's concerns about what the future of pensions looks like as well. So the bottom line is that with retirement planning, you need to incorporate all of the goals that you have, right? Whether it's needs, which are the utility bills, the insurance costs, whether it's your wants, hey, we want to be able to replace an auto every 7 years. And perhaps the wishes. It'd be great if we could put money towards our kids' college education, or, hey, what happens if we pull $35,000 out this year to pay for that 3-generation Disney cruise to the Bahamas? So it's really important to quantify this. It's important to recognize where the shortfalls may be. And really importantly, it's important to periodically track this. Who here used GPS on the way here today? We all did, right? I used it, and I still did a circle here at the end. But we use GPS. Why do we use GPS? For the audience.
Save time.
Save time? Okay, what else?
Most can't read a map.
Sir?
Most can't read a map.
Most can't read a map, okay. Who else?
Look for
Usually
traffic,
they'll
where
get
traffic
lost.
is.
Okay, so we're trying to get from point A to point B as efficiently as possible, right? And does it give you confidence when you have GPS pulled up on your screen? So it gives you confidence, right, to most efficiently get from point A to point B. Have you ever used GPS and all of a sudden you get to a construction zone or an accident, and then it's going ahead and giving you other options? I know this is a rhetorical question, but the point I'm making here is that the folks we work with, right, who have wealth, right, 9 out of 10 times we see folks come in, yes, the money's invested, but there is no hard copy financial plan, all right, that effectively builds in financial GPS for your journey, all right, for where you are today relative to where you want to be able to go. And so it's no different from using GPS in our autos to using GPS when it comes to our financial planning. So as far as questions, these are just some examples of questions, right? So are my assets going to be enough, right? And it's not a matter of back of the napkin or notebook or an Excel spreadsheet. Remember we talked about Monte Carlo simulations, or we referenced that. A few of you are familiar with that. I see some heads nodding. Sir, you were, third row back there? You, yes. What is your name, sir? Yes, you, Brown jacket. Yes, sir.
I'm Steve.
Steve. So you're familiar with Monte Carlo simulations? Okay. What is your understanding of how they work or what they do?
Well, you better not, I don't have a really sophisticated understanding.
Okay.
I just got on that.
Has anybody here seen the movie Oppenheimer?
Yeah.
Okay. The Manhattan Project and Los Alamos. So I watched the film and I was really looking forward to them referencing Monte Carlo simulations, but they didn't, all right? But the reason they're called Monte Carlo simulations is that when they were developing the atom bomb during the Manhattan Project, the scientists needed to come up with a name for it. And so they called it Monte Carlo simulations after the casino in Europe. What it does is it randomizes the outcomes, okay? It randomizes the outcomes in a financial plan, which are good, bad, and ugly during the rest of our lives, to give us ultimately a probability of success of whether we're going to be able to accomplish our goals. So for one client this week, she's only 86, okay? She said her goal is to spend every dollar, all right, of her capital over her remaining lifetime. So by running the Monte Carlo simulations, that is going to help that individual be able to determine each year how she's doing relative to what her long-term goals are, and can she pay for other things now without sacrificing lifestyle. So again, what we've noticed is that a good plan, we talked about GPS, does it give us a high degree of confidence? Does it account for our goals and where we are at different stages in our life, including inflation, issues like inflation, and then personal concerns, mitigating judgment and behavioral risks. So kitchen counter conversation, a few years ago, mom and dad were going on a cruise, sitting there at the counter, reviewing the portfolio with dad, and mom knew that the portfolio was down in value. So her concern was, do we need to go ahead and cancel that expensive trip? And the answer was no, all right, because the Monte Carlo simulations were built into the financial plan, all right? That still indicated a high degree of success because we built in the negative markets. So that provided confidence, right? It addressed the goals, and it mitigated any judgment there that could have been a sacrifice to lifestyle. Not doing that cruise because, oh, we can't do the cruise because the portfolio is that invaluable. No, we're using a bucket approach. That money is available because we're spending that money in the next year, and we've already accounted for that with the Monte Carlo simulations. We talked about longevity, all right, so very important. Again, we've got most folks in this room late career or retired. So really what we're trying to do is maintain lifestyle, generate sufficient income, meet healthcare expenses. Just had a phone call with a client yesterday. The spouse had a fall, is going to need additional healthcare needs met, right? There'll be additional healthcare expenses. So we're talking about continuing care retirement communities. We're talking about custodial care, what we need to do to be able to get that squared away. So again, I think the key point here is that if you look at this chart here, you can see that investment planning is just one spoke of the wheel. To really take, what we've noticed is that the most successful folks are taking a holistic approach to the planning, all right? And investment planning is just one part of that. So again, it's really important. The key point is periodically, just like you looked at GPS 30, 40 times on your way here perhaps today, it's really important that you have a plan in place where you are looking at the periodic reviews of where you stand relative to your goals. You see some reference here to a quarter. It'd be nice to be able to get an update where, hey, what is our probability of success? Many of you in this room have no risk of outliving your money, all right? But the question is, are you needlessly sacrificing lifestyle, all right? Is there more that you can do for yourself or your family? I grew up in a very middle-class household, all right? There wasn't a ton of money, all right? You learned the values of differentiating between needs, wants, and wishes, right? Living within your means, right? Sound familiar? What the word frugal meant, right? All the New England history in the family. So, but we only get one life, okay? And so it runs the full spectrum. Some of you in this room are at risk of outliving your capital based on what you're spending, and you don't know it, right? Because those are the blind spots as it appeals to judgment. Some of you, again, are going to end up passing away with a lot more money than you may care to at the end of the road, and so that's why it's important to go ahead and ensure that you've got that plan in place. So this is actually what it looks like, or what a plan should look like. So you should be, let's go ahead and make that, here we go. So everybody can see that. Okay, so you need to account for your expectations and concerns. So this is an example for this sample client: an active lifestyle, opportunity to help others, time to travel, putting pen to paper. Leaving money to others, right, as far as concerns, outliving resources, funding free time. The plan should include all of the expenses, right? So we've had some folks that will itemize this down to magazine subscriptions, right? Property taxes for the second home in Florida, whatever it might be. But just as a sample, you can see college here, you can see Florida home, which they classified as a need. You see the wants, right? Auto replacement, travel, wishes, boat. Accounting for the children, our grandchildren in the mix. A net worth summary so we can see where we stand relative to the goals, accounting for all assets, both tax sheltered and non-tax sheltered. Accounting for, as an example, sometimes we'll see folks that downsize from their home, right? So, and you see a business here, 1.25 million, current value, future value of $1 million. Why? Tax ramifications. But so if we have a client who's selling a house for, let's say, $800,000, they want to buy a $500,000 house, we want to account for that equity coming into the financial picture so that they have that money to pull from towards their needs. So again, a plan, remember that pie I showed you, right? It needs to account for everything, both the liquid assets as well as the illiquid assets, as well as insurance, for example. Social Security. I'm going to show you what we run for Social Security. You need to run Social Security analysis. Is anybody here not collecting Social Security yet? All right, a bunch of hands? Okay. So we can't do this in a notebook or again, on an Excel spreadsheet. We need to account for the Monte Carlo simulations to determine what's the best time to collect Social Security, not just for one spouse, but both spouses. Accounting for the liabilities, the different assets. Accounting for when we've had bear markets. Again, the worst time to experience a bear market, what we call sequence of returns risk, are those first 2 years of retirement. So ultimately, this is what we want to get to. And so you see it says what if right here. You're only seeing 3 right here. But a financial plan, again, what is a complete financial plan, is running these what if scenarios so that we're still in the confidence zone of not outliving our money. But if we're in the blue here, that means sacrifice of lifestyle. It means, why are we still working? You don't need to save as much, or you can spend more money. So again, financial GPS, making informed decisions. We only get one life again, right? Planning would be perfect if we know how much time we have, but the point is we get one life. Total spending, you can see here, it adds up, right? Inflation adjusted, $12 million. And then testing for bad timing. Retiring in 2032, congrats. The market moves down 18%. And now you need to know whether or not you're going to outlive your capital or not. And this is actually what the Monte Carlo simulations look like. So inside the numbers, you can see here that all the 1,000 Monte Carlo trials that were run, and this is the dispersion of outcomes. So this amount of money left over at the end, and current dollars, $36 million, and the worst trial showed $600,000 left over at the end. If we look at the 50th percentile trial, it shows $6.5 million left over at the end. The reason that's relevant is that this might be $6.5 million too much, all right? Or, you know what, the goal is to pass $7 million on to our 4 kids one day. So what do we need to do differently? But if you can picture here, here's the journey. Draw a car right here and envision each year pulling this up for yourself so you know exactly where you are on the journey. Do you see how that's relevant towards making informed decisions? This has nothing to do with investing, Okay? Investing is just one spoke of the wheel. A complete wealth management plan has to incorporate a financial plan that incorporates Monte Carlo simulations so that you can make the most informed decisions you can based on objective data to maximize the outcome not just for yourself, but for your family as well. So again, the goal is to be in the green. If it's in the purple, it means that we got to go back to the drawing table. We need to work longer, we need to spend less money, etc. So again, a good, complete financial plan accounts for bear market tests. All right. So what happens if things don't go well? So it might be a situation where the boxes for needs are checked off, but the wants and wishes, we can't check those off because we got to uncheck these rather in order to increase the probability of success. So again, needs, wants, and wishes, we all have them, and everybody's needs, wants, and wishes are unique. Okay, Social Security analysis, a bunch of you put your hands up. So this is, I really love this tool. Again, a complete plan needs to have this, but it's just giving an example of collecting as soon as possible versus collecting at retirement versus at full retirement age. So full retirement age, right, for many folks today is age 67, all right? So that's giving an example there of what we call full retirement age 70, and what if Tom collects at 70 and Maria collects at 67? So actually running the probability of success and then understanding what our break-even point is. So such an important decision because Social Security is a very relevant piece of the retirement income pie. All right, so that's what I wanted you guys to see as far as the financial plan was concerned. Does anybody have any questions related to that, to financial planning or what a financial plan should look like for each of you? Okay. All right, we're going to wrap up here. I can see the time. I said I would share an investment idea with you. And this is something we've seen growth in, both interest as well as allocated capital to over the years. Is anybody here familiar with structured notes? Does anybody have any capital assigned to structured notes? Okay. All right. So, show of hand, everybody here is familiar with the S&P 500? Okay. So, most of my capital is in equities, right? Equities, again, I have some of my own capital in alternative investments. I also have well into six figures in structured notes with my own capital, all right? And the structured notes are based on an index like the S&P 500. They're issued by the big banks, like we've all heard of Barclays, right? HSBC, right, out of England, the largest bank in the world. JP Morgan, Morgan Stanley, Credit Suisse, Royal Bank of Canada, RBC. They're issued by the banks because just like companies bringing, or investment firms bringing stocks to the market, right, like Facebook, Morgan Stanley brought Facebook to the market, bringing bonds to the market, they make their underwriting fees on bringing structured notes to the market. They are based for a finite amount of time, and so you can see here that this is approximately a 2-year note, which means that in 2 years, proceeds are paid out, whether the investor is positive or negative. What structured notes have is they have leverage to the upside. And so for this, if you look at your piece of paper, you can see where it says, this is 150% right here. So if the index is, whatever the index is up, the return is multiplied by 1.5. And that's the leverage to the upside. So if the index is up 10, what is the investor's return? What's 10 times 1.5? 15, right? So if the index is up 5, then investors are up 7.5%. So the reason that I have capital here, and again, this is a different idea, right? I get asked, hey, what about an investment idea? The structured notes provide leverage to the upside, subject to usually a capped maximum return, in this case 17.9%. What this means is that the S&P 500 is up 40% in 2 years, investors are limited to the 17.9% return. So this might be appropriate for investors who have a modest outlook on the markets, okay? But like the idea of getting a levered return to the upside, limited. In exchange for that, the dual directional piece these structured notes can actually result in a positive return even if the index is negative at final valuation. So as an example, if you look at your sheet here, it's showing that if, for example, if the index was down 5 or 10%, the investor actually earns a positive absolute return equal to the decline. So index is down 5, investors are positive 5. Index is down 10, investors are up 10. After that, there is 10% downside protection. So if the index is down 15, for example, the investor is only down 5. Okay? So the reason I use them, it's a way to protect some of the downside to a certain degree, get levered returns to the upside, and the trade-off is a capped return, right, in exchange for having some of that downside protection. Does that make sense? Any questions about this? Okay. The majority of capital, yes, ma'am.
How useful is this if you're dealing in smaller amounts? How useful is this if you're dealing in smaller amounts? How far down can you go before it's really not part of your portfolio? Because you started with 12 million. Not everybody here has 12 million.
So I wish every client started at 12 million. No, it runs the bell curve, right? You know, a couple million up to, call it $20 million, right? So, but it depends on the client. These may not be appropriate, number one, for some investors, right? It needs to be a personal conversation to see how they may fit. But what we like to do is look at the amount of liquid capital and assign, if we're going to strategically assign a certain amount of the portfolio to something like this, it could be 5 or 10 or even 20%. If that's the investment policy, if you will, then based on that, we still want to get diversification into other indices, okay? So the S&P 500 might be one, but there might be one based on Europe or Japan or emerging markets. So just like we want to generally build out a diversified approach to the portfolio with stocks or stock funds or exchange traded funds, we want to do the same thing with the notes. And so, you know, it could be, an investor could have, you know, 5 $20,000 notes, right? 5 different notes with 20,000 in 5 different indices, right? That are all maturing between 1.5 and 3 years. Remember I mentioned the bucket approach earlier, guys? Short-term, mid-term. My personal experience with this is they've reflected well on me for the moderate bucket, because with the moderate bucket, if these are maturing, it's giving us an opportunity to call an audible at the line of scrimmage. Hey, this note is maturing. Do we want to go ahead and use this towards that purchase this year, as an example? So I like the flexibility that they build in with staggered maturities, just like bonds. Any other questions, guys? Yes, sir.
Yeah, I think this is probably similar to the first question. What's the minimum that you can use for these kinds of notes?
There's not a minimum on that. Yep. Okay.
Then some clients have a healthy skepticism of the Monte Carlo simulation, and I was just wondering if you could share any information you may have seen or Morgan Stanley may have on kind of back-end experience with that. Like, how does this work out in the end, and can people rely on that?
Okay, great question. So, all right, so there's 2 types of analysis, linear and Monte Carlo. Does anybody want to take a stab at what linear means? Okay. Linear means assuming the same rate of return every year from now through the rest of our lives. Okay, so remember we looked at, let's just say that it's 5%. Has anybody ever seen the same return for your portfolio every single year? Okay, so it's not the real world. Can we agree on that? And so, let me just come back to that. So, here we go. I'm going to make this a little bit bigger to touch on that. Okay, so linear here would be your green and red line. Magical, same rate of return every year. The portfolio never fluctuates in value, okay? That's this green line here, but these gray lines represent largely the real world. Now, you see these outliers up here where you can see one trial here and another there, but you see how dark it is here? This is where the majority of the trials are happening, right in that 50% band, okay? So the Monte Carlo simulations, a financial plan is 110% not complete unless it's accounting for Monte Carlo simulations with your capital. because the linear is going to give us a false set of confidence, all right? Because that's not going to happen. The one other thing I'll point out here, since we're talking about this, is this red line here is bad timing, but it's still assuming linear returns here. But you can see here, just by experiencing 2 negative years at the beginning of retirement versus, let's say, 2 negative years at the end, towards the end of retirement, ultimately having a lesser amount of capital. What I can't show you with this is the bucket approach, right? That's important to design for all of our needs. Again, I give you an example, one bucket for Sherry and me, right, which is Reagan's and our son's college accounts, right? Getting more conservative as we are right there in college right now. Thank you, Steve. Any other comments or? Yes, sir.
More question.
Yes, Steve.
If you in using the Monte Carlo approach, it sounds like what you're trying to do is have an inventory of values, whether they're needs or wants or just a certain hierarchy, so that when you run the analysis and you're looking at measuring different risks. Each year, does the client have the ability to say, well, look, our ability to meet certain needs, it's not as strong, so maybe we need to adjust the wants or the wishes. Is that how that analysis helps the individual client?
So I think everybody heard Steve's question. So the answer is 100%, right? So in the practical sense, in the real world, I'll encourage clients you could be driving down the road, okay, and have that epiphany, right? Oh, I got a what-if scenario for Ben. Hey, the email goes off, hey Ben, what if we do this instead of this, and what about this, this, and this? So this Zoom call on Thursday morning is just that, right? This client is worried about being laid off, and that is going to impact what the pension looks like, right? Collecting a pension earlier. So he reached out to me, okay? So because he wants to have the confidence, all right, to be able to make informed decisions, right? It changes his whole outlook on everything by being able to do this, right? So again, I keep coming back to this. I'm not trying to beat this to death, but it's fully relevant. All of the data that goes into your GPS, my GPS, that we're seeing on our screen to make that happen, all right? Everything you got to put in the pot, right? Income, assets, Social Security, inflation, different needs, wants, and wishes. Well, we want to buy a new car every 5 years instead of 7 now. And can we do this one-off trip here and this and that? We want to give back to the University of Maryland, okay? Whatever it might be. So these are what-if scenarios that are always able to be changed. The nice thing is once the plan's in place, the foundation is set, right? And now it's a matter of decorating, right? We all live in homes. We've got the foundation. We've got the walls, the 2x4s, right? The drywall. Now it's decorating, right? Now we want to change the living room. We want to change the dining room. We want to put an addition on. Okay, well, let's go ahead and see what that looks like for you. Can you see how you'll have more confidence if you've got all that data fed in there and the ability to come back to that?
So basically what you're saying is that being able to run the model, not just running the model once or twice, but constantly rerunning the model so you can look at the different, how your financial resources can be allocated to the different priorities.
The answer to that is 100%, right? And this is the example that I gave to you. Was right here. I said, picture yourself in a car. Literally, this is 62. Right here. Picture yourself in the car. Right here. I literally draw a car right here. 2 people. Let's update it. Let's update it. Where do we stand? Where do we stand? Making informed decisions along the way. Maybe you want to gift more to the grandkids, during the holidays, right? Can we afford to do that? Well, if we can do it, where do we do it from? What's most tax efficient? So, to be unequivocally clear, all right, this is 25 years in, right? Investing should come after the financial plan. Remember, the folks we're meeting with, all right, they are successful people, they're wealthy, they're savvy, they're smart, but most of them coming in do not have this in place. It's that simple. And so I know it's true for this room because it's just the way that it goes, right? I haven't asked for a show of hands. So it's really important to have this in place. I hope that's evident, self-evident. And then this helps you determine how to invest the money. It shouldn't be the other way around. All right, I am bumping up against my time.
Thank you so much, Ben.
Yeah, I'm gonna,
Other questions for Ben before we take a break?
on your table, guys, these are two pieces, MIT Age Lab generated material. They're workbooks. I think you'll find them productive. I really genuinely love any feedback that you have after you go through these two pieces on your desk. And then there's a replay of Morgan Stanley's half-year outlook also on your desk. And so if you just email me, I can go ahead and send you the link to that.
Ben, thank you so much. Thank you so much, Ben. Dynamic. Very dynamic. We wish you the best from the lacrosse field today. Are you actually going to get out there yourself? Thank you, my friend. And we'll take a 10-minute break. 12 minutes, maybe.
So if everybody could take their seats.
James got all of our investment rolled into one guy that does that.
So we're going to start now.
And he wants me to roll.
We're going to start with a Maryland legislative update.
Gary, I think your microphone is off. And I just want to say before Ben leaves, because I know he has to go, let's give Ben a round of applause.
Can you hear me now?
Here, Gary.
Can you hear me now? Good, okay, inside your packets, I think in both Steve's clients and mine, there are two handouts. One of them has a Maryland legislative update, and the other is a summary of what's in the House bill that was recently passed. So let's start off with the Maryland update. There were not a lot of relevant statutory changes in the Maryland legislature this year. So let's take a look. There are 6 of them, 3 of which passed. First of all, the Maryland estate tax exemption is $5 million per person, $10 million per couple. Governor Moore has been pushing to, yes, question.
Is there supposed to be a handout with this information on it?
There is,
On the federal side. On the federal side, there is in Gary's.
there's none in the Maryland. You don't see one that looks like this?
The Maryland one's not there, just the federal.
Just the federal one? That's all right, because there's not much happened with the Maryland laws anyway. So, first of all, the legislature considered, but did not pass, a decrease of the Maryland estate tax exemption. It is currently now $5 million per person, $10 million per couple. They tried to pass a decrease to $2 million per person and $4 million per couple. It did not pass. So we're still at 5 and 10 for the Maryland exemptions. But don't be surprised, they're going to try and decrease it again next year. So all of our plans now are probably designed with a $5 and $10 million exemption. We need to keep an eye on this next year, and we will. A law that passed in Maryland regards compensation that can be paid to guardians of property, that is, if there's a guardianship of the property, and also for trustees' compensation. It used to be that there was a strict formula to compute what the commissions would be. The law that was passed now gives some more flexibility, that it can now be reasonable compensation as opposed to this statutory formula. Next, there was a law that passed that provided that if a trustee wants to resign, he or she could do that with 30 days notice to the beneficiaries. Now, in the trust that I prepared for my clients, and I believe the trust that Steve has prepared for his clients, there is already language in the trust that says that a trustee can resign with 30 days notice to the beneficiary and to any other co-trustees. There is another law that was passed. It's not really going to affect us. Maryland passed a law that assigns a task force to study fiduciary adjudication. Plain English, if there's a contest with a trustee or a guardianship, there is a law that was passed that we're now going to look into what laws we might want to pass regarding contested trustee issues and contested guardianship interests. One can create a trust for the beneficiary of a spouse. It's called a spousal lifetime access trust. Laws were presented to the legislature. They did not pass. And finally, there was a law that was considered but did not pass regarding attorney-client privilege with fiduciaries. In other words, the fiduciary, even if it's being paid by the attorney, there were questions about attorney-client privilege in that situation. The law did not pass. So basically, the two laws that will really affect us are notice to trustees or notice from trustees if they want to resign, and also compensation of guardians and compensations of trustees. There is a House bill that passed. It has not gotten to the Senate. My understanding from reading all this, and I think Steve is keeping up with this as well, right now it's maybe 50-50 or less that the Senate will pass the House bill. There are 4, I think, senators who have already expressed their concern about the proposed House bill. What I've noticed over the past couple of years, and especially when President Trump was in office, is that often senators who right off the bat come off and say they're not crazy about a proposed House bill, somehow or another it generally gets passed. Now, what I don't want to really spend a lot of time doing is going over the main parts of the big bill, but a couple of them that I think might be relevant for all of us. It's proposed, first of all, that the standard deduction be boosted $2,000 for joint filers, $1,500 for heads of household, and $1,000 if you're single. The next one that I think we want to watch is, and this is pretty important, the SALT deduction, state and local tax deduction. Right now, we're all capped at $10,000. And what happens is in a state like Maryland, where we have a lot of income taxes, we're losing the ability in Maryland on our federal return to deduct state and local taxes. The proposal in the bill that the House passed was raising that to as high as $40,000. That would be helpful for people in Maryland and other states where there are high income taxes. I guess you would consider that the blue states. If the law about the SALT increase doesn't pass, we will continue to be blue in those states. Next, I try. You know, some work, some don't. I don't have a test group. They're part of the big tax bill, which is going to be helpful for me because I need to buy a car pretty soon. There is a law in the big bill that says that you can deduct interest payments on cars that were manufactured, well actually the final point of manufacture in the United States. If you buy a new car and the final point of assembly was the United States, you may be able to actually deduct the interest on a loan for that car.
Question, John?
Yes?
Does that apply to existing loans or only new loans?
New loan, new car, okay? Next, the proposal is to increase the standard deduction for seniors by $4,000 for years 2025 through 2028. That's not going to help me. I won't be a senior for another, 20 years, I think. And the final one that I think we all want to take a look at is, right now, we have a pretty high estate tax exemption for the federal returns. The proposal is to keep to raise the actual federal return, the federal exemption from up to $15,000 a person, $30,000 per couple. So there are a lot of proposed changes. It is in the handout that you have. My thought was those were the 4 or 5 that I'm really interested in. So that brings you up to date. There was not a lot of news coming out of the Maryland legislature for estate planning. And we'll find out what happens. Supposedly the president says he'd like to know by July 4. We'll find out. And so that's the update for the Maryland changes to the law. Steve, you wanted to have a couple of things you want to say about it?
Yes, thanks, Gary.
Okay.
All right, be thinking about those Father's Day stories. Okay, the good ones, not the hasty. I also wanted to say, we're talking about current legislative update, and wanted to mention, for those of you who are interested, remember that the ABLE account laws are being changed in 2026 coming out, where someone with a disability prior to age 46 can have an ABLE account and not just age 26. So that's kind of a big deal for people with disabilities. So I'm going to get to some funding comments and some things and trends that I'm seeing that I just want to make you aware of that I think are a little bit alarming and I want to bring to your attention. But let me just follow up with Gary's comments, reading straight from the Maryland State Bar Association's Estate and Trust section newsletter on the bills that were updated. Some of them didn't pass. And I just want you to be aware that your Estate and Trust Section Council of the Maryland State Bar Association, I think, is doing a heck of a job pushing ahead progressive changes. The one that Gary mentioned, the Spousal Lifetime Access Trust, even though that doesn't affect a lot of people, it affects certain people who want to make gifts between spouses of large amounts to use their exemption amounts before the exemption amounts were supposedly going to go away, but maybe they won't. Maybe the exemption amounts are going to be extended to the $15 million permanent exemption that you're hearing about. So that's going to be adjusted for inflation if that happens, and I'm very glad to hear that the Congress is acting sooner than later on this, and then we're not going to be waiting until September, October, November for this. But in the Maryland legislature, the bill that didn't pass was trying to be more progressive, such as states as Delaware and Nevada, where someone can make a large gift and still be a beneficiary of that same money, and a certain class of beneficiaries at a certain time later on down the road. So in other words, you can give money away and still not be separated from the possibility of being a beneficiary of your own gift. Even though that didn't pass in Maryland, and that's allowable in other states, it just shows that our section council is trying to be progressive. So reading straight from the newsletter very quickly, four of the 6 bills that were sponsored by the Estate and Trust Section Council passed both chambers and were signed into law by Governor Moore. In addition, 3 other bills that affect our practice area were passed by the legislature and became law. So I'm just going to reiterate a certain amount of what Gary said. Compensation of trustees, and this is important because most of your trusts and wills say that compensation is reasonable compensation. But if you were to ask me 6 months ago, I would have told you there's a lot of discrepancy about trustee compensation. Is it statutory? Is it set by a fee schedule? Or is it reasonable compensation? So let me read this very quickly to you. On October 1st, 2025, if a trust agreement is governed by Maryland law and does not specify the compensation a trustee is to receive, the trustee is entitled to compensation that is reasonable under the circumstances. This is a change from the current Maryland law, which provides that trustees are to receive a certain percentage of income and principal as compensation. And of course, the state law, of course, provides for statutory compensation, and that's what this is talking about. So I'm not going to, go into great detail on this, but the factors go into what is reasonable, are the value and character of the trust property, the risk and responsibility of administering the trust property, and so forth. The new law does not provide that compensation of the trustee based on a fixed percentage is reasonable per se. So just know that there's a lot of ambiguity, and this helps clear that up about what reasonable compensation is in certain circumstances. Resignation of trustee, as Gary just said, if a trust agreement does not describe the method by which a trustee can resign from his or her role, current law states that a trustee may resign with approval of a court. But on October 1st, 2025, Maryland law will include a second method by which a trustee can resign. Trustees of a trust that does not specify how a trustee is to resign will be able to resign with at least 30 days notice to qualified beneficiaries and so forth. Now, this is one that Gary didn't mention, and it's only because it's a little bit obscure, and this is decanting. So, you know, at our last session, we talked about decanting. We talked about other ways that there's so much flexibility in the law that maybe it's gone so far in this direction that we need to maybe step back a little bit and ask ourselves, how can we make sure that our estate plans are actually going to work the way we want despite all this flexibility? Well, remember, decanting is a way to make a significant amendment to an existing trust or change the trust completely. This talks about the notices that are required in decanting, because remember, decanting means you put a trust into place that's now going to be changed in some way. So notice is a big issue. Notice of a decanting trust must be provided 60 days prior to the intended exercise of the decanting power to the settlor of the first trust. Each qualified beneficiary of the first trust, each holder of the presently exercisable power of appointment over the first trust, and so forth. And this really gets into more detail about what notice has to be done, how it has to be provided. So on October 1st, 2025, notice will be deemed proper if provided by personal service, certified or first-class mail, postage, return receipt, and so forth, courier service, and other types of delivery. So you can imagine that if you have a trust and it's going to be decanted, you're going to want your qualified beneficiaries to have notice. And so that notice is important. I won't go into detail about fiduciary adjudication that Gary talked about, but that's in the law. Priority of claims on an estate. Many of you may be aware that in an estate, which many of you don't have a probate estate because you planned for a non-probate disposition, remember that under the current law, in an estate, unpaid child support is included in a last category of a creditor priority of an insolvent estate. But as of October 1st, 2025, unpaid child support will move up in priority. And this is good public policy because we know that child support is important. And I see so many cases where child support is unpaid. And I don't know how it's happening, but there's a lot of loopholes in how child support gets paid. Domestic partnership and marriage, there's new required information for couples who register as domestic partners after October 1st, or who are applying for a marriage license. They'll need to provide for certain information. So these are all updates. And lastly, uniform disposition of abandoned property. Remember, there's a lot of abandoned property out there, and there are new laws relating to that. The revisions to the Act include making certain virtual currency subject to the abandoned property law, so cryptocurrency and other currencies. All right, so that is the Maryland legislative update. Now I'm going to just switch to a few comments now about funding and alignment. And but before I go there, let's just talk about what Gary mentioned, which was how Maryland may revisit a reduction in the estate tax exemption. So, you know, Maryland's economic forecast and so forth has not been good recently, according to Dr. Basu, who I look to as an authority on that. And, you know, if we ever have a reduction in the estate tax exemption, we're going to want to look, for those of you who are married, we're going to want to look at the spousal formula, and Gary alluded to this. The spousal formula, remember, on the death of one spouse, how assets go to the surviving spouse. And remember, in that spousal formula, if it goes by marital deduction, okay, you're going to have the portability laws that allow the surviving spouse to take advantage of both exemption amounts. But we also want to be very cognizant, for those of you of higher net worth, we want to make sure that we may not want to use the marital deduction. We may want to capture a certain amount in the non-marital share, because if the survivor of you lives many years, we want to make sure that the growth doesn't outpace the exemption amount. So in other words, if you look at assets that go to the surviving spouse, that's fine because we have portability. But what if the Maryland exemption was lower and we exceed the portability amount? So now you would have been exposed to estate tax But if we use the non-marital share, whatever growth there is in the non-marital share on the death of the first spouse, that growth over the years in the following years would be excluded from estate tax. So I just think it's a healthy thing to think about because we don't really know what's going to happen in the Maryland or the federal legislatures. All right, let's talk about funding and alignment as we start to wrap up for the day. I'm going to get you out of here on time. Thank you for coming, despite all of the traffic and everything. I understand some of you had to deal with coming here. Maybe it discouraged others from coming. That's why we have so many lunches left over. If you haven't grabbed your lunch, well, I see many of you did, so grab an extra one, right? Okay, so let's talk about funding and alignment. Remember, funding and alignment, we haven't done an exercise on funding and alignment in quite some time. But remember, you're going to want to look at your assets, make sure they're properly retitled. Non-retirement accounts of all kinds. Checking, saving, money markets, savings bonds even, mutual funds, stocks and bonds. All of your non-retirement assets need to be in your revocable trust as a general rule of thumb. Stocks, bonds, mutual funds, cash, CDs, anything that you can imagine, you want to take a second look at that. Now, if you haven't put these assets on a spreadsheet, you should check and double check your spreadsheet. You should check and double check your beneficiary designations. Is it something we can take for granted after COVID, our beneficiary designations? Well, I'm going to argue no, you can't take that for granted. You have to check and double check your beneficiary designations, including life insurance, okay? If you have an LLC, we want to make sure your LLC is assigned to your revocable trust as a general rule of thumb. It's just a time to check and double check all of your beneficiary designations, all of your funding. Now, let me talk to you about a couple of things as we start to wrap up that I've seen recently. So many of you have revocable living trusts, okay? And many of you have financial advisors, and we heard from Ben this morning, and I know we have financial advisors in the room. But I'm just going to give you an example of what I've seen more than once recently, and it was rather alarming. So I found a few situations where a first spouse died, okay, and their financial advisor had told them, or maybe it was a mix-up, and this is why you can't take anything for granted. I want to paint this picture now. Here's the revocable trust, right? And there's this spouse, first spouse to die. Here's the surviving spouse. And instead of leaving the IRA to the surviving spouse, okay, so how would that normally work? Well, we would normally leave it to the surviving spouse, and the surviving spouse will get what? A rollover IRA, right? And that's good. That's the most efficient thing. That's asset protection for the surviving spouse. Or sometimes a person will say, well, I'm going to leave my large IRA or 401k to a marital trust or a non-marital trust. That sometimes can happen too. But in this particular case, someone left $1 million IRA to the revocable trust itself. So they had a joint revocable trust. They left the IRA directly to the revocable trust instead of the surviving spouse. Now, this is a little bit of a mind-numbing thing to talk about on a Saturday, but can you leave an IRA to a revocable trust? Yes, you can. So the IRS has something called the see-through trust rules. So let's pretend the second spouse died, or if you're single, you left your IRA to your revocable trust. There are techniques where you can actually use the revocable trust as a funnel to funnel down the IRA. Now, I don't like that technique because there are ways that can blow up. If there's a charitable beneficiary in there, or if the IRA documents don't get to the custodian, if the revocable trust documents don't get to the custodian by October of the year following death, if the rules aren't followed, the IRA money will blow up. So I don't like that technique, but sometimes attorneys will use the revocable trust to funnel down the IRA money at the death of the last person to die, or a single person. But that's not what I'm talking about. I'm talking about a spouse who died, there's a surviving spouse, and they left the IRA money, instead of to the survivor, they left it to the revocable trust. So I'm just pointing this out. This is a hazard. Financial advisors, as we've talked about before, can be extremely competent, right? Like we heard this morning. Financial advisors want to provide tremendous value. Sometimes that value extends to confusing clients, right? And so here, this person, for whatever reason, maybe it was the financial advisor's fault, maybe it wasn't, they beneficiary designated it to the revocable trust when there was a surviving spouse. Even though the revocable trust says everything goes to the surviving spouse, it stopped that person from being able to have a rollover. So in other words, it destroyed the rollover, and we were worried that it was actually going to trigger tax on the whole thing, and it was actually going to fail. So fortunately, Fidelity or Schwab or whoever it was allowed an inherited IRA for the surviving spouse, which is not quite as good. That's not what we really wanted. And the rollover was really basically destroyed. So be careful that you don't want to, unless there was some reason, you don't want to leave your revocable trust itself as the beneficiary of an IRA when you have a spouse. You just don't want to do that, okay? You can leave it to a sub-trust, like a marital trust or a non-marital trust, but the most efficient thing is a rollover. Okay, so that's one of the things we're seeing, and I want to just point that out. The other thing I want to point out is the thing I've mentioned before, is someone advising that you use transferable on death, TOD, as your estate plan. So you're a member of the client care program, you're very diligent, but somehow someone advises you to take your large brokerage account and make it TOD to the beneficiaries. So I'm just pointing something out. I know we have a lot of smart people in here. Just be aware that that would thwart your entire estate plan, because TOD is point A to point B with nothing in between. And usually if you have a revocable trust, and Gary would probably agree with me, we want to use the revocable trust as a tool to funnel down the assets, be an incapacity planning tool, provide for the disposition the way you want. And we don't generally want to have our assets go TOD, even though TOD is not horrible, it does have its place, but it is not a substitute for a revocable trust. So if you are a person in this room, I know you've put a lot of thought in how your assets flow down through your revocable trust. Don't blow that up by having TOD, and you didn't intend for that to happen. So be intentional is what I'm saying. The other thing I want to talk about is, we talked about spousal disposition and how that might be important for estate tax in the future. We're going to keep both eyes open. We talked about spreadsheets. We've talked about beneficiary designating an IRA to a revocable trust. That's a no-no if there's a surviving spouse. And now I want to talk about beneficiary designations again. So remember, beneficiary designations are very straightforward, either to an individual or to a trust. Remember, an IRA can be owned by a trust. The question is, should it be? Some parents are going to beneficiary designate assets to a trust, a retirement plan to a trust. Why? They want to provide asset protection for the child for some special purpose, like special needs planning. So just remember, we want to check and double check. Now, many of you attended the 2 meetings ago. We talked about beneficiary deemed owner trust. We talked about the new technique for non-special needs children or non-special needs beneficiaries, where you can use this technique to have IRA assets in a trust, and there are trade-offs, but generally speaking, this is a pretty powerful technique to be able to have an IRA owned by a trust for a child, let's say, and that IRA money will stay in that trust longer, in theory. So the BDOT technique, the beneficiary deemed owner trust technique, we want to take a look at that for many of your plans and say, okay, if we are leaving an IRA to a trust, do we want to use the BDOT technique? So those of you that were here 2 CCP meetings ago, we talked about the BDOT. It's still out there, it's still viable. It is about leaving an IRA to a trust in a certain way. So some of you that do that, some of you that use the BDOT technique, which we can review next time if we need to, some of you are going to be mixing
retirement and non-retirement plans in the same trust. So maybe we would want to use a separate standalone retirement plan trust for certain IRA assets. So remember, beneficiary designations, avoiding the spousal IRA into a revocable trust when we have a surviving spouse, being able to think clearly about revocable trust versus sub-trusts under a revocable trust, and then again, just keeping both eyes open. If you have a larger IRA and you are leaving that to a general needs beneficiary, a person that's healthy, right, healthy and well, you can use the VDOT technique, which we talked about a couple meetings ago. And if you do use the VDOT technique, remember you are giving the beneficiary a withdrawal right over income. So if you want to make sure that withdrawal right over income only applies to the IRA, we might have to use a separate retirement plan trust. So again, your membership here at the CCP, we take it very seriously. And remember, we want to look at our funding, always be diligent about what advice you're getting in the various circles. And the last thing I'll say is, and I don't have it with me right up here, but I have a 30-page outline from the Maryland State Bar Association Estates and Trust section dinner the other night, where they brought in a high-flying estate planner from New Jersey who talked to everyone. 30 to 35-page outline about what's happening, what we should watch out for. But what I want to assure you of as we wrap up is that you're doing the right thing, you're on target, because even in the context of the dinner that I was at, they were talking about the fundamentals, reviewing your estate plan, making sure your asset spreadsheets are updated, making sure that your beneficiaries are updated, making sure your healthcare directives. So the fundamentals never change, and I'll leave it at that. Gary, do you have any closing comments? And does anyone have a Father's Day story they want to tell before we go?
You have one more. Go ahead, Gary. Can you all hear me still? Well, now that we've covered all the relatively non-important stuff, what I'd like to do is show off. We have a crack legal research team headed by Mr. Stephen Elville. And last night he was up till about, 2 in the morning,
2:30,
doing a lot of research. We've heard about all these relevant laws. What we decided to do is find out what kind of unique laws are in this country. So what I've done is I prepared 10 examples of crazy laws in this country, and it's going to be your job to figure out which is not a real law. I'm going to ask Steve which he thinks is the fake law. We're going to take a vote and see who wins. Ready? Number 1. In Culpeper, Virginia, no one may wash a mule on the sidewalk. Number 2. In McLeod, Kansas, it is illegal to wash your false teeth in a public drinking fountain. And number 3, in Portland, Oregon, it is illegal to sell cigarettes on Sunday. See, 2 of these are actual laws, 1 of them is not. Which do you think is not?
It's tough. This is a tough one, Gary. I absolutely believe the first one, and I absolutely believe the second one, so I don't think it's the third. I think it's the third one.
Everybody, you think the first law is real or not?
Yes.
Yes.
Yeah.
Number 2, real or not?
No.
Real.
Number 3, real or not?
No.
The first 2 are actual laws. The third one, I made up. Next, in Michigan, it is illegal to sell a car on a Sunday. Next, it is illegal in Louisiana to wrestle alligators without a permit. Finally, it is against the law in Baltimore to bring a lion to a theater. Steve, which of these laws do you think is not real?
Number 1.
Number 1, in Michigan, it is illegal to sell a car on Sunday. Who agrees with Steve?
Yeah, I'm gonna go with that.
All right, a few. Number 2, who thinks that is the fake law? 1 person. Number 3, who thinks that number 3 is a fake law? That's for most people. Guess what? It is not illegal to sell a car on Sunday. It is illegal to bring a lion to a theater involved. Next. First, Is it illegal to wear short pants in indoor gatherings of 75 people or more in Greensboro, South Carolina? That's the first one. Second, is it against the law to spit orange seeds on the sidewalk in Mobile, Alabama? Third, is it illegal to shoot missiles at parade participants in Racine, Wisconsin? Steve, of these, which do you think is not real?
Gary, knowing the fireworks nuts that I've met in my life, I think 3 is real. I think it must be 1 that is fake.
All right, everybody, who thinks number 1 is a fake law? About 4 people. Who think number 2 is a fake law? Okay, about 8 people. Who thinks number 3 is a fake law? About 3 people. The answer is number 1. That's not real. You cannot spit orange seeds in the sidewalk in Mobile, Alabama. You cannot shoot missiles at parade participants in Racine, Wisconsin. Next. First, do you think it's illegal to chain an alligator to a fire hydrant in Michigan? Next, is it illegal to allow pigs to run free in Michigan unless it has a nose ring? Third, is it illegal to spit on a public sidewalk in Olympia, Washington? Steve, which of these do you think is fake?
Gary, I'm losing my perspective here.
All right, everybody, who thinks number 1 is the fake? 3 people. 4 people. Who think number 2 is the fake? About 5 people, 7 people. Who thinks number 3 is the fake? All right, nobody voted for number 3 because number 3 is not a real law. It is illegal to chain an alligator to a fire hydrant in Michigan. It is illegal to allow pigs to run free in Michigan unless it has a nose ring. Ready? Number 5.
Alligators in Michigan.
I think that's some of the University of Florida football team visits. All right. Number 5. It is illegal to have an ice cream cone in your back pocket in Kentucky. Number 2. It is illegal in Maryland to broadcast the song Short People by Randy Newman on the radio. Number 3. I can't believe this. Is it illegal to place a coin in your ear in Hawaii? All right, who thinks number 1 is a fake? Really? Only 5? Number 2, who do you, is it illegal in Maryland to broadcast a song Short People on the radio? About 3 or 4 people. Number 3, is it illegal to place a coin in your ear in Hawaii? 1 person. All right, here's the deal. It is illegal to have an ice cream cone in your back pocket in Kentucky? No. It is. By the way, I looked these up. And it is illegal to place a coin in your ear in Hawaii. No. All right? Number 6. It is illegal to throw a knife at a man wearing a striped suit in Tacoma, Kansas. Number 2. It is illegal to catch fish with your bare hands in Kansas. And number 3. It is illegal to whistle. It is illegal to whistle in a church in Kansas. Who thinks number 1 is a fake law? A lot of people. Who thinks number 2 is a fake law? There's 1. Who thinks number 3 is a fake law? About 8 people. It is illegal to throw a knife at a man wearing a striped suit in Tacoma, Kansas. And it is illegal to catch fish with your bare hands in Kansas. Yes, it is. You can look it up. Number 7. You already did this one. You already did this one. All right, number 7. It is illegal to eat peanuts in church in Massachusetts. Number 2. Bathing 2 babies in the same tub at the same time in Los Angeles is illegal. And number 3. It is illegal in Maryland to pass away without a fully funded living trust. Unfortunately, it's difficult to sentence the perpetrator of such an offense. So which one's a fake law?
3.
Number 3. Number 8. It is illegal to eat an orange in a bathtub in California. Number 2. In Florida, it is illegal to crossbreed alligators and crocodiles. And number 3, in New York, it is illegal for a man to go out in public wearing non-matching pants and jackets. Steve, stand up for a second. All right, so who thinks number one's the fake law? How many people think number one's the fake?
Yeah.
All right. Who thinks number two is the fake law? Nobody. Who thinks number three is the fake law? All right, so nobody voted for number two. It is illegal to eat an orange in your bathtub in California, and it is illegal in New York for a man to go out in public wearing a Number two is the fake. All right, we only got two more. This is the best part of the morning, isn't it? First, sneezing in public is illegal in Asheville, North Carolina. 2, in Sarasota, Florida, wearing a bikini on the beach after 5 p.m. is illegal. And number 3, in Indiana, it is illegal to take a bath between October All right, who thinks number 1's a fake? About 2 people. Who think number 2 is a fake? 2 people. Who think number 3 is a fake? I knew you'd not get this right. Sneezing is illegal in public in Asheville.
No.
And yes, it is. And it is illegal to take a bath between October and March. I got this book, this is Crazy Laws, and I actually Googled all these things and found the statutes of other ordinances. Last one. In Logan, Utah, a woman may not swear in public. Number 2, it is illegal to whistle underwater, by the way, and it doesn't say in West Virginia. It's illegal to whistle underwater in West Virginia. And number 3, in Allentown, Pennsylvania, it is illegal to display a flag with the color yellow. Who thinks number 1 is a fake? Nobody. Who thinks number 2 is a fake? A lot of people. Who thinks number 3 is the fake? All right, the answer is, in Logan, Utah, a woman may not swear in public. Number 2, it is illegal to whistle underwater not only in West Virginia, but in Vermont.
It's not possible to whisper.
Maybe someone from West Virginia who actually wrote that. And finally, number 3, that's the fake. It's not illegal to display a flag with the color yellow in Pennsylvania. So that's it.
Gary, we have final comments from Jeff.
Final comments from Jeff. Come on up, Jeff. Please no comments on the last section of the morning.
So thank you everybody for being here today. Really grateful for you being members of our client care program. Hope you found a lot of value. I thought Ben's presentation was really great in that it solidified my ideas of what financial planning is about. It took me 48 years to do my first financial plan with my wife for the 2 reasons that I didn't want to know. I didn't want to know what the results were going to be. And I realized those were 2 bad reasons not to consider financial planning. So if you go through that process, you'll feel much better after you did. So as our client care program goes on for the year, we have our annual client event on October 18th. Looking forward to that over at Tenix Ballroom. Again, in Clarksville, we'll have initial invitations out in the next 3 weeks or so. And then we have our social event in November before the holidays, and we're going to get a 4th quarter education event in early December. So look forward to seeing you then. Anything else that you need, please reach out to Gary, me, or Steve. I'm always happy to be a resource to you. And we'll see you again soon.